What's up, everyone? I hope you're doing great. Tristan Clunis here, and we've been doing these webinars for you. I'm enjoying them a lot. This is the third one. Make sure you subscribe below. Make sure you go back and look at the previous seminars that we've done or webinars. Lots of great information in there. But I have a really good one because we've talked about in the past, as I said, go back and check out those videos. We talked about, investing, taking your home, your existing home, and taking that money out and buying other properties. We spoke about the financing portion of that. We spoke about new construction, buying pre-construction properties with like new build properties, condos or townhouses. But today, we're actually going to be having a conversation about the very first steps in real estate. So I literally named it First Steps to Becoming a First-Time Buyer. And the reason why I'm very excited because I think there's a lot of people that are in this position, especially with what's going on in the market. Prices have jumped up significantly. People feel like they can't actually get in. I'm here to say that there are ways for you to get in, and we're going to be discussing them now. I have a good friend of mine, actually, who is a certified financial planner. He does holistic plans for people, literally starting them from the beginning and walking them through a full journey in terms of how they can become financially wealthy, whether it's buy your home, insurance, all these things. He pretty much puts together great plans for his clients. He's been doing it for a while. How many years now? 18 years. And I'm going to get into introduce himself. His name is Trevor Chew, and you just say the name of your company as well, brother?
Yeah, so my name is Trevor Chew. I'm a certified financial planner. My company is Legacy Financial.
Nice.
Yeah.
Awesome. And how long have you been doing it?
18
years.
Yeah, I started when I was like really young.
When you're like 4 years old?
I actually wrote my licensing exam when I was 17. And I had to wait till I was 18 to actually find a firm to work for.
What?
So I've been independent since I was 18.
So you knew you were going to do this?
When I was in high school.
Wow.
Yeah.
So you knew you were going to do this? This is what
I didn't know growing up, but I kind of fell into it. But yeah,
What got you into it? I'm just curious.
I had a late friend that passed. He just brought me into this company. I did my co-op there, and
Right.
I just found this financial literacy thing. They didn't really teach us anything about financial literacy in school.
Right.
But what also changed it for me, I also lost a close friend when he was about 26 in my practice, and just going through that process with the widow, just kind of like solidified what I wanted to do.
Right. Which is, I'm guessing, so that's the insurance side of things?
Financial planning, holistic financial planning.
Got you.
Yeah, insurance is included in that as well.
Perfect.
Yeah.
So the reason why I thought that you would be the best person to speak to about this is people are like, okay, that's great. I know I should go to a mortgage broker. We've talked about going to a mortgage broker, going to a bank in order to get a pre-approval, to get a mortgage. That's what you need in order to buy your first home. But what we never discussed was, okay, well, how do I even get to that point? What are the first steps to even just get to a mortgage broker? There's a lot of people that are in positions right now that, they have to figure out what their credit looks like. So we're going to discuss credit. They got to figure out, okay, how am I going to save that down payment? Where is that going to come from? We're going to discuss down payment. People that have they have an income, they're working, but maybe their income is not enough. They're trying to figure out, okay, well, where else can the income come from? Because these are all main things that you need in order to buy a home. And then we're going to talk about debt, school debt, OSAP, all these things that people that are kind of like hovering over people like a dark cloud. We're going to discuss the ways for you to be able to conquer it and be able to take all that and potentially buy your first home. So I really want to get into it if we can.
Yeah. I mean, a home is going to be one of the largest purchases you're ever going to make in your lifetime.
Right.
I mean, we make plans for meal prep. We make plans for all sorts of things. It makes sense to make a plan to buy that asset that you want to buy. Right. So, I would work for the certified financial planner. Currently in Ontario, you can't really call yourself a financial planner anymore unless you're certified.
Unless you're actually certified.
So I encourage you to find somebody who's certified who will help you holistically. Because buying a home affects a lot of different things. It may affect your taxes. It may affect your retirement. It may affect your estate.
Right.
So it ties into a lot of different things. So what I do is I sit down with the client and I use 5 fundamental principles to build a financial plan with them.
Okay.
So it's spend less than you earn.
Okay.
So I'll do a cash flow with them. What is your income minus your expenses? Is it positive? If you buy a home, are you still going to be house poor?
Right. So we're going to get into all that. Let's get into it. Let's get into it.
That.
Yes.
Okay.
So one thing I want to bring up, I have for some people that don't know, the reason why this is very, very, very important to me is I have a lot of friends, a lot of family members that are in this position that want to buy and can't do it. I just even think it for me, like I was I was born and raised in Jane and Finch. Was living in Driftwood. For people that know Jane and Finch, up top Driftwood. I was on top of a store. We lived there for 10 years, and then I moved. My mom wanted to move out. We shipped out to Brampton, but I ended up moving with my dad in Scarborough. And at that time, we moved from kind of one hood to the next. We moved to Galloway, which is G-Way. And the reason why I'm bringing this up, later on, my dad, we ended up moving out of there to Port Union. They're still there, which is great. But the reason why I'm bringing that up is we were like always, I guess, in a mindset of thinking that this is it. You know what I mean? Like I have to be in Metro housing or Toronto housing. I have to be living, I don't want to say average, but below average almost in a way, below, not poverty, but below average way where you're paycheck to paycheck, and you're that whole nine. Like I went through it, I've been there, and there's so many people that are in that position that will love to get information, and all they need is information. They need a guide, they need somebody that's going to show them their way in order to buy their first home. Right. So that's why it's very, very important. I know I've known you for years, so you know a lot of what I'm even talking about. Right. So, and I'm guessing that's probably what, as you said, you mentioned your friend passed away. You probably have a lot of people that are in the same position that want to buy a home but couldn't.
Yeah, I mean, the housing price, if people thought it was bad back then, it's even worse now, right? So yeah, starting sooner than later is probably a lot better.
Perfect.
A house is something you're going to own long term,
right?
So I wouldn't be necessarily too concerned if it's going to go up or down. I mean, if you do have a recession or depression, if it goes down, you're probably not going to sell it. You're probably going to live in it long term, right? Being in your first home.
And the ups and downs of real estate only affect you when you sell. Right. So you can go up, it can go down. If you're not selling, who cares?
Yeah. A lot of people these days are concerned about like inflation, but reality is we're at the end of a 50-year debt cycle. So usually when interest rates are close to zero, central banks, they can't really lower the interest rate anymore. Right. So they printed money, as we saw. They're putting an end to that. So now they want to increase the interest rate. They can't really increase it that much. You know, the Bank of Canada just raised the rate maybe last week by 0.5%, 1/4%.
1/4%, yes.
And now we're at half.
Right.
We're still at historical lows.
Which is pretty low.
And they still don't want to increase it, right? Which tells you something. So, I mean, if we have issues, likely, I mean, you probably see more inflation this year because of what's going on, the lockdowns, and the ports and war and stuff like that. But once all that clears, I think inflation will eventually settle. Okay,
perfect. So let's get to it. So the first part of it is down payment. You're a first-time buyer. These are people that are looking to buy their first home, and they have no idea. They have no money saved. They're living paycheck to paycheck. How do they save for a down payment? What are their options?
Okay, so the first thing they can do on their own is they can do a cash flow. They take their income, they take their expenses, and they look at how much do I have left over each month.
Right.
Is it negative? If it's negative, then we need to fix that. Usually if it's negative, it's tied to debt.
Gotcha.
We're at all record time highs with debt. Right. I used to be a mortgage broker during the financial crisis. They let me give 105% financing. So we give you 5% to buy a house back then, right?
Right.
So that created a lot of debt, but we have at least 3 times that amount of debt today. So a lot of people are dealing with a lot of debt. Of course, with inflation, people losing their jobs or not being able to work or having reduced hours, that also can affect that as well, right? So often I'll talk to people about debt. You always want to pay off the highest interest rate card first.
Okay.
If you're at a point where you have maxed out all your limits, you can do something called a debt management program. So this is not a consumer proposal. It's not a bankruptcy. It's much better for your credit. You still pay back the debt. But what happens is a nonprofit organization will negotiate with the lender to bring your interest rate close to zero.
Oh, interesting.
So I've done this with several clients, and they've actually paid off their debt a lot faster, and they actually paid less into their debt because they're not servicing 20% interest rates.
And they're not, and that doesn't show up on their credit?
It doesn't show up on TransUnion. It only gets reported to Equifax for 3 years, but it shows that they repaid the debt.
I see.
So it looks much better on their credit.
Got you.
So besides that, repaying debt, before you buy a home, you want to stay away from getting into any more debt.
Gotcha.
When I was a mortgage broker, a couple of times I've lost deals where people went out and, hey, I got a car loan.
Oh my gosh, I have tons of stories like that. Oh my goodness, I really do. Where people literally 2 weeks, 3 weeks before they're closing,
just wait.
Do not buy a car. Do not rack up your credit cards 2 to 3, 4 weeks before you're closing. Once you buy your home, just don't touch any credit. Don't touch it. Wait until you actually close on your property. Then, hey, man, you're free to do whatever you want.
It's interesting. King Solomon said, the rich rule over the poor and the borrower is slave to the lender.
Correct.
When they're charging you like 20%. You're literally
Right.
slave. If you go to one of those payday loan places, it's like 30, 40%.
You can't get out of it.
You can never get out of it.
You literally you're always paying back just to get yourself back to zero, but then you need more money after that, right?
So it's a terrible cycle because they put these things in places where people probably shouldn't get them in the first place. So I have lots of clients who end up into bad debt because of that.
So you mentioned paying off their highest interest card or debt first and then work your way down. So that's like, I think that's what the avalanche method. Because from what I understand, when it comes to debt reduction or debt payment,
there's a snowball method. It's all about your psychology. Gotcha. If you feel better paying off a certain card, then do that. But the reality is, you will save interest if you pay off the highest debt first.
Gotcha.
But if it doesn't work for you, then it doesn't work for you. Use the other method.
And the snowball method, that's where
you pick a card, you pay that off first, and then you go down the line.
Right. So you'll pick a card, pay. I think so the snowball, you list all your debts. You look at the one that's, I guess, the smallest debt, and you pay that one off quick while you're paying the minimum on all the others. Once you knock that one out, it's kind of like a win, like a small win for you. Right. So like, yay, like I'm ready to go to the next. Right. You pay that, you put all your attention to that one while paying the minimum payments on the other debts. Knock that out and slowly get up from there. So that's an option. It's not it's not the paying off the highest interest rate yet.
Right, but psychologically it may work for more.
Right, mentally people feel like they have a win, so they can just knock it out. So there's different options out there.
Yeah.
Got you.
If you have good credit, you should negotiate with your lenders. Try to find a line of credit at a lower interest rate.
Right. You
can actually call your credit company once a year. Call them on your birthday. Say, hey, it's my birthday. Can you lower my interest rate or increase my limit? They'll actually do that.
Will they say happy birthday and then do it, or how does that work?
They should.
Fair enough. Down payment. So there's a couple of things. When you and I spoke, you told me that there's plans that are out there for people when it comes to getting the down payment.
So the common one most people hear about is the first-time home buyers plan. So you can borrow up to $35,000 from your existing RSP.
Right.
If you have a spouse, then $70,000. Okay. A lot of people don't realize this. Well, first, before we get into that, so the way it's repaid is on the second year, 1/15 is repaid. Okay. By buying RSPs at any institution. If you don't buy back that 1/15, it just gets added to your income that year.
Gotcha.
So it's not a big deal if you don't buy it back. And remember, you already bought the RSP to create a deduction anyways.
Right.
So it's not a big deal. A lot of people don't realize financial institutions are not allowed to put a lien against your RSPs.
Interesting.
So you can actually take a line of credit, or I can give you an RSP loan. You could put it in an RSP, wait 90 days, and create a down payment out of nothing in 90 days and use that as your down payment. So,
so people just don't know that information, or?
Not as common knowledge, no.
That's very interesting.
So if you got good cash flow, little to no debt,
right,
you could use this because one, you get an RSP deduction of $35,000.
Right.
So you get a large tax receipt you can use for your closing costs or renovations. And you also put a larger down payment. So you want to try to put down 20% if you can. If you don't, the bank will force you to buy CMHC insurance.
Right, which a lot of people are kind of in that position, unfortunately.
This insurance, so let's say you buy a $300,000 home. I don't know if you can get that, but let's say you put down 5%.
Sorry, did you say? Sorry, guys. When we're recording this, we're right now in Toronto right now, right? Shout out to Don Mills. We're in Toronto.
Let's say
you cannot find even a condo for $300,000 unless you're, unless you're buying certain areas. Even still, probably will list $300,000, but it's actually going for like $500,000.
Well, okay, so let's consider that it's really low. If you just put 5% on a $300,000 home, CMHC fee is going to be like $12,000, $13,000 lowered upfront to your mortgage.
Right.
So you double that, that's like 20-something thousand.
Right.
This insurance doesn't even protect you. I've had clients who've got their property foreclosed. CMHC paid the bank, turn around and ask my client for the money.
Right.
So the bank forces you to buy insurance for them.
Wow. Fair enough.
So if you can avoid it, then that's one good strategy. Ideally,
yeah. So what he's saying is, if you could put down more than 20%, so 20% or more when you're buying a home, that's the ideal situation. There are other options though. You could do 10. You could do as low as 5, depending on the situation. 5%, right? So it just depends on your scenario. Ideally, you want to put down at least 20% on the place.
I mean, you count the cost too. So when I sit down with a client, I look at their rent as well. I mean, if they're paying a lot of rent and it may be cheaper to own sometimes,
right,
or more advantageous, then it doesn't really matter if they put down just 5%.
Okay. So the RSP, that's one way of getting a down payment. I know you have a couple others.
Well, before we go on to that, with the RSP is really important. You just don't go run out there and do it, because you take a loan.
Oh no, you can't just go don't
go take a loan.
Fair enough.
Make sure you want to do it with a financial planner, because you want to make sure you cash flow properly.
Right.
Get a mortgage broker in the bank to get you a pre-approval with the RSP loan considered in the pre-approval. So you want to make sure you can still qualify for both. If it doesn't make sense, don't do it.
So a lot of people, what they will do, they'll go to a bank, run to the bank and say, hey, I want to do this because I heard I can take it out and use it, the RSP as my down payment. But then they're not looking at the full picture because that's actually also a loan where it can affect you on your purchase, right? So having somebody that's looking after everything, kind of seeing it from like, bird's eye view to kind of put together and map out everything for you, that's ideal.
The other thing is you probably shouldn't invest it either. If you're going to use it as a down payment in 90 days, you want to make sure it's still there.
That is in the account, ready to rock.
Yeah, our economy right now is very volatile.
Right.
You don't want to risk it for a down payment, right?
Very interesting.
Another form of down payment not too many people are aware of is life insurance.
Okay.
So a lot of people they may have a policy that their parents bought for them when they were a lot younger. It may have policy values. If they take a policy loan, it doesn't even come out of the policy. A lot of people don't understand how life insurance works. When you get a policy loan, it comes from the insurance company. Your values stay in the policy, continue to grow tax-free.
Interesting.
So for that reason, it doesn't show up on your credit.
Right.
You can take a policy loan. You can take a life insurance policy to the bank, to the specialized lending department, and they will collateralize that, and that will also not show up on your credit. The only time it will show up on your credit is if you do a commercial loan.
Gotcha.
So I work with a lot of realtors where they want to figure out different financing methods. We use this, we put, like, instead of just parking your money at the bank, park it at an insurance company, borrow the insurance company's money, use your down payment, and your money is sitting in the policy going tax-free. So now you've created two uses for your money instead of one.
Fair enough. How often do you see that situation playing out like that?
This is more for like high net worth clients who have the money, or maybe a client who sold a house and wants to park the money somewhere before they buy their next house, which what I did recently. Like I sold one of my rentals, I put into this policy.
Yeah.
It's giving me 6% tax-free. It's going to give me a better passive income than my rental property without the headache of tenants.
Gotcha.
Properties. And what I'm going to do is use that to buy other real estate property.
Fair enough. Fair enough. So those are your two. So you said through life insurance, you mentioned RSP. Any other options?
So there's another program. The government will give you an interest-free loan through CMHC, 5% on an existing home, 10% on a new build. Now the thing is, it's interest-free, but you have to repay it when you sell the house or in 25 years, and they get equity in your home.
Gotcha. And what's that percentage?
5,
whatever you borrow.
So 5% or 5%, 10%.
Got you.
Yeah, so that's the only downside to that. So people aren't as gung-ho about that. And there are income limits to that as well.
So the government becomes your partner essentially.
Yeah. But
I mean, it's not necessarily a bad thing if you're in a situation where you're thinking about it. I mean, it's still a decent option given your situation, right? Everybody's situation is different.
I mean, think about it. Even if you're paying slightly higher than rent, a lot of the money that's going towards the mortgage is going into your savings because it's saving into the equity of the home. So in the future, when you sell it, you'll get that money back, or you can borrow that money out or take it out that way.
Right.
So having a home, do the cash flow plan. And what I usually do with clients is I sit down, I look at their cash flow, and I create what's called a mock mortgage for them.
Okay.
So we simulate what it's like to own a home in the future. So let's say we get you a pre-approval, your mortgage is going to be $2,000 a month. I advise you split it up to bi-weekly.
Okay.
The difference between accelerated...
People are so used to doing the monthly. Everything's usually bi-monthly.
Do accelerated bi-weekly. The difference between normal bi-weekly and accelerated bi-weekly is like over $10,000 in interest savings over 25 years.
Wow.
And it's only like a $50 difference per pay.
Right.
Okay. So let's say it's $2,000. We do $1,000 bi-weekly.
Right.
We plus your utilities costs.
Sure.
Right? Let's say your current rate is $1,000. So we take your future mortgage payment and living costs minus your current rent.
Okay.
And that's how much you would save into this mock mortgage. So the whole idea is going to simulate what it's going to cost to own a home in the future. You're saving for a down payment. And then you can also decide, do I want to buy at that price of a house?
Right.
Am I going to be house poor? Will I still be able to save and invest and retire? Or am I just going to be putting all my money into this house?
Do you recommend people? So I did a video about buying where you can afford, but renting where you want to live. Mm-hmm. Like, is that a situation that you would recommend in that regard? Like if it's a situation where you do the mortgage and it's for an area that you want to live in, for whatever reason, you can't afford, like it's just way too much money. So you're running negative or whatever the case may be, you can't afford to do it, you're going to be house poor. Yeah. Would you recommend people to go and say, go buy a rental or go buy something else and then rent where you live currently?
And so rent out their property and live somewhere else?
Right. So like, for example, if I'm in Toronto and can't afford it in Toronto, for whatever reason, prices are way too high, can't afford to do it, buying, let's say.
Oh, buy far away and live in Toronto.
Correct.
Live where you want, rent where you want to live.
Exactly.
I mean, you can often do that because when you buy in these outskirts, the house pricing is going to be a lot cheaper.
Right.
But the rent might be relative.
Right.
right? So yeah, I have clients who travel out farther. They buy a cheaper house, they split it up, they rent it out,
Right.
multiple units.
Perfect. Awesome. So that's down payment. I mean, any other things that you want to touch on in regards to down payments?
So besides down payment, I mean,
because I was gonna get into credit next. That's what I want.
Yeah, we can talk. It'll tie into that.
Yeah.
So credit, when you're paying down into your house, you're also creating another form of down payment. Because remember, that equity you can take back out. You sell that house, you can use that money to buy another place.
100%.
So there's a way you can transform your house into a banking system. So I personally have this special mortgage. It's a bank account, line of credit, and mortgage all in one account.
Interesting.
Okay, so there's only 2 institutions that do this. Okay,
right.
All the other institutions, it's a mortgage with a line of credit that moves up and down as you pay it down, but it's not a bank account. Because my account is also a bank account, I can forward my paycheck into there. I can forward my child tax benefit into there. As soon as it hits the account, I'm not charged simple daily interest.
Wow.
This mortgage charges me simple daily interest, not compounded.
Right.
So the money sits against there, and because it's a bank account, I can re-access my equity anytime.
Right.
So literally, they give me a bank card and a checkbook. I can access my equity anytime.
So your home literally becomes an account.
Yeah. So that's the only downside to it. So if you have clients that are not good with
that, are just gonna be like swipe, it's
not for you.
Please, no Gucci, no Louis V.
But if you're disciplined, you understand that debt, your slave is borrowed to the lender, then yeah, you can use this as a tool. So what you do is you use your credit card. So I always advise my clients, get a cashback credit card with no fee.
Okay.
Get 2% cash back. Your money sits against your interest for 30 days. You get really creative. You use the line of credit to pay off your credit card. Now you have 60 days where you paycheck where your money sat against your mortgage and save you simple daily interest. The compounding effect of that over several years is you pay off your mortgage literally half the time. You save tens of thousands of dollars of interest by simply changing the way you bank.
So you're saying if you have a 25-year mortgage, 25-year amortization.
If you got a decent cash flow, you can pay it off in half the time.
12 and a half.
And this is the thing, my interest rate on my mortgage is higher than traditional mortgages.
Right.
But I pay less interest.
Because of the setup, because of how you set it up.
Because I can prepay my mortgage. There's no amortization to my mortgage, meaning I can pay it off anytime. I can let it run as long as it wants. I'll never get a renewal. I'll never have to requalify.
Interesting.
Okay? If I get into an accident and I can't work, well, I don't have to pay my mortgage until the equity gets eaten up by the interest. So I could get away for years without paying my mortgage. Okay.
And how many, you said only 2 lenders?
Only 2 lenders do this. And I only know one really well that I deal with.
That you have a relationship with?
Yeah, and most mortgage brokers actually don't offer this because they have to take special courses to sometimes offer this. So you probably won't hear about it.
I've never heard of it.
Yeah.
Like this is my first, I've been doing this 10 years and this is, well, not more, I haven't been a mortgage broker, I've been a realtor for 10 years. I haven't heard of any clients doing it.
Yeah,
that's very interesting.
So the other good thing about this is once you paid out your house, remember you have access to your equity. Traditional mortgages, there's a reason why they only let you prepay 15%.
Right.
Or if you break the mortgage, there's a hefty penalty. Right. That's how they make their money, right? With this mortgage, there's none of that. You can break it any time. But that's the very reason why people don't prepay their mortgage. Because once you pay your mortgage, the money is how you're going to access it back.
Right. It's just locked. It's just locked.
You're going to have to requalify unless you got a revolving line of credit.
Right.
Whereas this mortgage is a bank account. As soon as you put it in, you can take it out the next day.
So help me understand. So where they benefit is the interest rate. They charge a higher interest rate.
They charge a higher interest.
What would be the number? So let's
my mortgage right now is 3.05.
And let's say you're just to get a regular mortgage, how much would that be?
Probably right now, traditional, maybe average, maybe like 2%, 2.5%, depending on your credit.
Got you. So about a point, depending on the situation.
But when I run illustrations, I actually save a lot of interest, even though my mortgage has a higher interest rate, because I pay less interest. I'm prepaying my mortgage. So
that's the thing. I think people, and this is not just for first-time buyers. This is for everyone. If you own a home, we can get so caught up on interest rates. We can get so caught up on, oh, I want the lowest interest rate. Sometimes it's the terms or that can be appealing to you, why you would probably go for a higher interest rate as opposed to going, just fixate on this low interest rate.
There's a reason why an open mortgage has a higher interest rate, because you can break it without
you have penalty. The options, right?
You buy a house, and what if you need to sell it? And all of a sudden, you break the interest rate. Now you paid more in interest, even though you had the low interest rate.
Right. Awesome. And just because we're on interest rate, can you just give, just for the public and for everybody watching, can you talk to us about the difference between like your variable rate and a fixed rate? Yeah.
So variable just means it goes up and down. It's connected to the prime rate. So right now, prime rate is just under 3%. So usually a bank will either minus the prime rate or plus, depending on your credit level.
Gotcha.
So if you're lucky, maybe you'll get a prime minus 1%, something like that. So it'll be lower than the prime rate. As the variable rate changes, your rate may change as well, but typically you won't really notice much of a difference.
Right.
They'll just increase the interest payment.
Whereas fixed
is fixed. You get a 2% interest rate. It's fixed for the term. So 1 year, 2 year, 3 year, 5 year, even 10-year term, you can lock it in for.
So no matter what happens in the market, that's your rate.
Most variable mortgages you can also lock in. So let's say you get a variable mortgage, you decide, well, I'm scared about interest rates increasing. You can lock it in.
Right. Most of them
you're allowed to do that.
So and then with fixed as well, usually from my understanding, if you decide that you want to break your fixed mortgage, they charge you.
So they charge you 3 months interest.
Right.
Or interest rate differential, whichever is greater.
Right.
So
which can get expensive, of course.
It can get in the tens of thousands of dollars.
Right.
Yeah.
Easily. Fair enough. Yeah. Okay, so that's lots of information there, bro.
Yeah.
We're talking about interest rates. I know we're kind of going into the whole down payment, but I want to talk about credit.
Okay.
A lot of people are in positions where, whatever reason, their teen years, right when 18, I think, right when you turn 18, if you're on campus at Ryerson, any campus, you usually have those companies, those credit card companies ready to go. They'll give you their card in 2 seconds. Just give them your name, SIN, address, and you'll have a card in no time. And obviously, as an 18-year-old, we're not taught at all, unfortunately, anything with credit or how to manage money. So people are just taking this credit card and just swiping away. I'm going to get the Jordans. I'm going to go to this. I'm going to go to that. And get themselves in really, really bad situations credit-wise. Yeah, so, I'm just wanting to know, there's a few people, I'm pretty sure there's a lot of people, I've been there where, my credit hasn't been the greatest at all. And I've had to do certain things in order to get my credit up.
Yeah. So credit, I mean, there's 2 credit bureaus. So there's Equifax and TransUnion. So everything you do gets reported there. So if you're late 1 month, 2 months, 3 months, we can tell it's all coded. Right. So when I was a mortgage broker, I would pull people's credit and I would give them their credit report. If you want a free credit report, you can go to Equifax. They'll give you one for free just without your credit score.
Right.
But on there, you'll see how late you were, if you owe the Ministry of Transportation monies, if you owe payday loans, everything shows up on there.
It's all there.
Okay. So you want to make sure you pay everything on time.
I want to just touch on credit because I have people that, they had their phone bill with Rogers or with TELUS say, yo, I'm not paying Dutty Rogers. I'm not paying Dutty TELUS. Forget that. I'm not going to pay my bill. I'm just going to let them be. They're not getting my money. They're not getting my money. In the meantime, guys, TELUS and Rogers, they're reporting this to Equifax and to TransUnion. So that does show on your credit, and that will have a huge effect on your credit.
Yeah, if it's gone to collections, they're likely not charging interest on it anymore. You can call collections, start to negotiate with them. Say, hey, I don't have all the money. Will you settle it if I give you a quarter of the money?
Right.
Or maybe half. Sometimes if it's long enough, they're desperate enough, they'll settle it with you.
Right.
So.
Yeah, so I just want to bring that up because I know I've heard of those conversations. I've had those conversations with people where they kind of just forget about their old TELUS bill or their old Rogers bill. That will have an effect on you potentially getting a house or getting a mortgage. So please deal with that. They do report it. It shows up. If you're late, it will show up. If you're 30 days plus late, it shows up on your credit and it can have a negative effect. Yeah. But anyways, get into I just wanted to that sounds like that's been always a situation I've heard over the years. But yeah.
Things like student loans aren't as bad.
Okay.
Because usually the interest rate's a lot lower.
Right.
5 to 7%, and usually you can deduct the interest on your taxes. But if that's your only debt, you still want to try to pay it down. It will increase your ability to qualify for a mortgage. So the way debt and credit works with mortgages is basically the more debt you have, the less mortgage you can qualify for.
Right.
The banks don't want to lend you more debt than say about 30 to 40% of your income.
Got you.
So 30 to 40% of your income.
And that's take-home income?
Yeah, it's gross.
Gross.
They have 2 calculations. They have gross and they have total debt calculations. They use both.
So that's before taxes.
Yes. One is before. Yeah, they're both before taxes.
Gotcha.
Actually, no. I think no. They're net. It's net. It should be net.
So it's net. So it's after you say take the taxes out. CRA gets their money, and then they're looking at how much money you're actually working with. Right. Fair enough.
So basically, try not to get into any more debt. So
gotcha.
Car loans is a big thing.
And what kind of credit score does one need to have in order to get a mortgage?
I mean, you can go pretty low. I mean, I've seen you can go to a B lender, 600s, maybe 5. You can go to a private lender if you want to. The interest rate is going to be a lot higher. The mortgage broker may charge an extra fee for that. But if you want to get an A lender, like a good lender, probably 700s.
Right. I think 680 is kind of like the number that I would normally just say 700, but I think 680 to kind of be in that A lender plus.
600s, yeah.
High 600, 680, you want to get your credit up there. And what are ways, we talked about debt reduction. Is that the only way, making sure that I guess you pay your phone bills and pay all these things off on time?
Pay everything on time.
Right, because it shows.
Get a line of credit at a lower interest rate, consolidate the debts into that. And yeah, just try not to borrow. Stay away from borrowing things.
Fair enough. Yeah. Awesome. So that's credit. Talk to me about income. Income is becoming even more of an issue lately, especially because of the stress tests and the whole nine.
Yeah.
What are ways that people, like, let's say they're working a regular job, what are ways that they could increase their income in order to buy a home?
I mean, you could create more income.
Sure.
Business is always a great way. I always encourage people. Like, I've been self-employed pretty much my whole career. I've only had one job my whole life. I would never be employed ever again. So, I mean, there's certain things you can do and certain freedoms you have as being employed. So
right.
if you can work a regular job and start a business on the side, create some passive or extra income, that's always encouraged, whether it be Uber or whatever.
Right. And I'm guessing they would want to see at least 2 years.
Yeah, typically lenders want to see 2 years business income.
Right.
You can create, you file it on your taxes, you talk to your accountant about it.
So that job that you're doing or that business that you're doing, if you're not filing taxes for it, it's not going to be, like, you can't count it, guys. It has to be stated income. So 2 years of stated business income, you filing taxes on that side hustle that you're doing, just so that you can make sure that you can use it as income when you're ready to buy a home.
Yeah. Make sure you file your taxes.
File your taxes.
You might have a refund.
You need to file your tax. They look at that, of course. They want to see your notice of assessment.
Yeah, they want to see if you're owing any taxes.
Yeah.
As well. Yeah.
I've almost had that situation happen to me. And yeah, I had to pay a nice hefty tax bill before I end up buying the first home. It was sucky, but it is what it is.
Taxes are probably one of the most expensive debts we pay.
Right.
Because taxes is a form of debt.
Getting around it, it's like, so there's ways of, I'm not getting around it fully, but like there's ways of.
There's legal ways that you can plan to get,
right.
to reduce your tax bill or eliminate some taxes. Yes.
Right.
The good thing about buying a home is it's tax-free. It's one of the few assets in Canada that's tax-free.
Right.
So principal residence for now is taxfree. Tax-free savings.
Except for now, you're scaring me. Jeez, yeah, fair enough. Because they've been talking about it lately.
Well, they'll probably increase capital gains tax in the future. They've increased it. They've changed it 5 times since the 1970s.
Fair enough. Wow, okay.
They probably won't attack principal residence for now. They'll probably go after capital gains first before they touch that.
Gotcha.
But that for now is tax-free. Shares of a private corporation or a farm property is tax-free.
Okay.
Up to roughly $1 million worth of shares. Life insurance proceeds are tax-free. Growth inside a life insurance policy is tax-free. And the TFSA is tax-free. Right. Other than that, everything else you can't really invest in. Bursaries, lotteries, stuff like that. You can't invest in it.
Right.
So home is one of the few things you can actually invest in tax-free.
Perfect.
So, and again, as you save into it, you're saving into your house.
Right.
You're saving into your house.
Yeah, because the house is going up. I mean, ideally, a house is going up in value as well, but then you're paying down the mortgage, you're building equity in those ways. So those are like the main ways, guys. I want to kind of just wrap that up. Obviously, down payment. We discussed the different options that you can do in order to increase your down payment or to actually get a down payment from zero, which is awesome. Credit is very important. Paying down your debts, making sure that you're paying everything on time. We spoke about income. If you're doing a side hustle in order for you to, increase your income, make sure that make sure it's stated income. Make sure you're filing taxes on that business. They need to see at least 2 years of business income in order for them to even accept it.
Another option for income is they could buy a property and say they're going to rent out part of the property. So some lenders will consider 50 to 70% of the rental income.
Right. Nice.
So that's another way to increase your income.
Oh, that's perfect. Well, there you go.
I did that personally. I bought my first house. I rented it out. I lived in one room, paid off the house in a couple of years, and I just sold that house last year.
That's like house hacking, essentially. Yeah. Everybody else is paying for you to be there, essentially.
Well, yeah, it was turning a profit as well.
Yeah.
So it worked out pretty well.
Positive cash flow.
And it was cheap rent for everybody. Nobody wanted to leave the house.
Right. So getting people out would have been that's the biggest challenge you had.
It was a difficult choice to make. I didn't want to, but I mean, I had to after reassessing everything.
You saying sell it? Sell the property?
Yeah, I ended up selling it.
Fair enough.
Because second properties are taxed.
Right.
Principal gains, capital gains
is
tax, right? So
fair enough. Question for you. Any other topics that you want to just touch on in regards to like first-time buyers that you want to
first-time home buyers? Yeah, like really sit down. I would do a financial plan, at least a cash flow bare minimum to see where you're at financially. Another thing you're going to have to start thinking about is title insurance.
Okay.
So when you buy the house, you're going to register your title with the lawyer. The lawyer's going to offer you, if you want to buy title insurance, make sure you buy it.
Okay.
Title insurance protects you from problems with the property before you owned it.
Right.
Example, when I bought my property, the guy didn't pay his tax bill or water bill for like years.
Jeez.
I would have to pay like tens of thousands of dollars to hook up my water. Okay. But property tax took care of it.
Right.
I had another friend, the city came and said, hey, we have to put a sidewalk on your property. Your fence is in city property. You gotta move your fence. It cost him $25,000 to do
wow.
that. I told him, call title insurance. Title insurance took care of it. So
Took
make
care of
sure
it, no
you
problem.
buy title insurance. Is about a couple $100, maybe 300, 500,
worth every dime.
$600 one time up front. It's
I
worth
agree.
it. The other thing you want to start thinking about is when you buy that house,
Yep.
you're going to go to the bank or lender and they're going to offer you this bank mortgage insurance.
Right.
I would advise don't buy it. Just get your own insurance directly with the insurance company. The
Gotcha.
bank mortgage insurance covers only the mortgage. So you got a decreasing mortgage and you're paying group rates. You're paying rates for everybody else in that pool because they do all the underwriting, not up front, but when you make the claim.
Right.
So not only are you paying more, it's decreasing insurance. It's only going to the bank. But if you make a claim and you didn't answer it properly, they might not even pay it.
Jeez.
So get your own policy that's fully underwritten up front.
Right.
Where they may ask you for blood, urine. Most companies these days, you can get up to $2 million. They won't ask for that.
Go through the whole process. It is what
just
it is.
randomly.
Yeah.
But you want to protect your most valuable financial asset.
Right.
A lot of people think it's the house. It's not the house. It's you.
Right.
If I give you a chart and I show you how much you're going to make from now to age 65,
You'd be surprised.
It's millions of dollars.
Right.
Right. You are your most valuable asset. So if something happens to you, you want to make sure you can still keep that house.
Right.
So not only do you want to make a plan of how to purchase that house, you want to make a plan of how do you keep that house, and eventually how are you going to pass that house on to the next generation?
Nice.
In a tax efficient way, right? So again, you're your most valuable asset. Nearly 50% of foreclosures are due to disability or illness.
Right.
Yeah, most people are protecting themselves against death.
But not disability.
Not disability or illness.
Getting in an accident, whatever the case may be. Yeah.
So in terms of risk management, like the most likely thing to happen in your lifetime. So home insurance, you got like 1 in 1,000 chance of making a claim. You should still get home insurance. So when you buy a home, make sure you buy home insurance.
Right. Right. Yes.
Car insurance, you got 1 in 300 chance of making a claim. Life 1 in 60. Critical illness used to be 1 in 3. It's 1 in 2 for cancer alone.
Wow.
I had several people in my practice, even close members of my family, had cancer.
Wow.
So it's real. They can putting stuff in our food,
environment,
whatnot. So you want to protect against that. You want to protect your most valuable financial asset against the most likely to occur risk. Because if it does occur, how are you going to keep that house?
Right.
You got 1 chance of contracting cancer in your lifetime. If you get cancer and you can't work for a year and you got to go to the hospital to get treatment.
Bills don't stop.
The bills don't stop.
No.
How are you going to pay that mortgage?
Right.
So this is why, you should consider some form of like critical illness insurance. There are ways where you can buy it where it's almost free. So I have a policy. I pay about just under $2,000 a year. I pay for 20 years for $100,000. After 20 years, it's paid up for the rest of my life.
Right.
Lasts the rest of my life. But if I stay healthy, I want to cancel it, I can take all my money back.
Right. So
the cost for that policy for me was the opportunity cost. What would I have earned on $2,000 if I invested at the bank? If it's supposed to be an emergency fund, it's nothing. Right. Taxable interest at like a quarter, not even a 0.25%.
Right.
So if you got good cash flow, that's a great way to protect your most valuable asset against, one of the most likely to occur risks.
Fair enough.
So things like that. And also, on the insurance side, on the life insurance side, just get basic term insurance.
Okay.
You can get $1 million, a young person, $30. I suggest a 10-year term because most 10-year terms you can exchange for a 20-year term in the first 5 years without a medical.
Right.
And the other reason is you want to lock in your insurability. There's a lot of things you can do that we can talk about later that you can do tax-free that you can't do with other assets. Remember, I told you there's only few assets that are tax-free in Canada, life insurance being one of them. I've maxed out my TFSAs. I have nowhere else to put my money tax-free, other than the specialized exempt tax-exempt insurance policies.
Fair enough.
So if you lock in your insurability, you can just convert to that stuff later on without a medical.
Right.
I had a 26-year-old in my practice. She was perfectly healthy. She was running like 10K a week, running marathons, eating a whole foods diet.
Right.
We got her insured. The next year, she had type 1 diabetes.
Jeez.
A lot of stuff that I'm going to talk to you about that I do personally, she wouldn't be able to do if we didn't lock in her insurability.
At that time.
Time. So because remember, these companies, they're providing returns based on people's health. It's not so much based on the economy. So when they screen people for health, that's how they're able to pay out these profits to people.
Right.
Return them in form of dividends, right? So if you're not healthy,
you
can't do a lot of, there's like half of the things you can do that are tax-free out there. Gone.
Wow. That's literally a topic on its own, to be honest with you.
Yeah.
So we're going to have you back to just talk about just insurance alone. Life insurance, disability insurance.
Yeah, I just did a seminar for a real estate firm about how, if you want to incorporate and hold real estate in a corporation, what that looks like.
Right.
Estate planning, how you want to pass on real estate to the next generation.
Right.
Like my grandfather was a real estate investor. He bought properties in Alberta. He put them into holding companies. But a lot of people don't realize when you pass away, all your second properties are deemed disposed of, and all your non-registered assets are deemed disposed of at fair market value. So what that means is CRA wants to tax belonging on all your second properties and all your non-registered investments, even though you did not sell them.
Wow.
So my grandfather's estate, we didn't have the money. We were forced to sell our properties at discount. That's usually what happens if you don't plan for this property.
Right.
If you have it in a corporation, insurance creates a special tax-free dividend in the corporation that allows shareholders to pull it out tax-free. So if you structure it properly, you can run a pretty tax-efficient structure that way.
We're gonna have to get into that. This is gonna go over a lot of first-time buyers' heads.
Yeah, but those are things
it's
you
good
can eventually get into.
But
with.
That's why I'm glad you brought it up, because I want to kind of like expand people's mind and say, okay, these are your options, and a lot of people don't know about these things. So we're gonna have to have you back for sure. Guarantee. Where can they find you, man?
Legacyfinancial.ca.
Okay.
My phone number is 416-738-9721. You can just call me if you want.
Perfect.
Or you just contact Tristan. Tristan, I work partner with you. I offer holistic financial plans to your clients.
We've done a few clients together, and to be honest with you, they would not be in their position to buy if it had been for you, like to put them in, to set everything up, put together their plan, put them on the right path, the right journey, so that when they get to me, because once they get to me, to be honest with you, there's a lot of things that has to happen before they even get to me. So you setting them up first is ideal situation, right?
It's a lot to think about.
Yeah.
It's one of the largest purchases you're making in their lifetime. So you
spend the time.
Sure you do it right.
Give this guy a call. So legacyfinancial.ca. Give him a call. He also left his number, so you can always rewind and listen to it again before. Of course, I'm Trevor Chew. If you're not subscribed yet, please subscribe. I do these I'm trying to do them once a month, where we have content that's going to bring you value. Today, I'm thinking that it's actually a really, really good one, because there's a lot of people that are in this exact same position trying to figure out what to do. So I'm happy to do this. I love doing it, but please subscribe, like the video below. If you have any questions, if you want to get in contact with Trevor, you can get at me or you can get at him directly. And also, again, all my social media is at Tristan Clunis, TristanClunis. So Instagram, Facebook, whatever, I'm there. You can find me there. So hope that's great. You're good?
Yeah,
awesome. Thanks so much for tuning in. And remember, clueless, ask clueless. Have a great day.